What's up, guys? I'm going to be making a video on the fair value gap today. If you're unaware, the fair value gap is a 3-bar price action pattern used in the ICT community, but there is some debate on who actually discovered the fair value gap first. Some people say it was actually Arbucci, who was an old school price action pattern trader. I've learned a lot from him as well. Either way, this debate doesn't really matter to me. The point is that the fair value gap is a very dynamic tool that can be used in your trading strategy for a wide range of things. It's really powerful to my concepts and the way I view price action. So we're going to get into how you can identify it and then how you can use it in your trading. And then I'm also going to go over some stats from the Edgeful platform because they actually just put up a report on fair value gaps and it's really helpful information. So let's just get into it. All right, so what is the fair value gap? A fair value gap is a 3-candle formation that has an expansive candle in the middle that causes a gap between the wicks on the first and last candle. This creates an imbalance. Now, why are imbalances in the market significant? They show areas in price that have had large amounts of aggressive buying and selling, moving price too quickly and not providing an efficient market. The market's goal is to create efficient buying and selling for its participants, which means these imbalances can act as magnets in the future for price to draw towards. The other reason fair value gaps are significant is because they show displacement or expansion, which can signal trend reversal or continuation. And I'm going to show examples of both of these in the charts in just a moment. Now, what do we use fair value gaps for? Unlike other candle patterns, the fair value gap has a wide range of ways to be used in your analysis. Kind of what I was just going over. They can be used for higher time frame levels to spot reversals, trade entries, and even directional bias. All right, so let's get some visual representations here now. I'm going to show you guys how to identify the fair value gap. Now we're looking at the NASDAQ futures chart. I'm in the replay mode, and right here on July 11th is where we last put in our all-time highs, and then we have had a pretty significant sell-off since. Now, let's show you how to identify the fair value gap and show you exactly what it looks like. So if you see here, we have candle number 1, we have candle number 2, this is our expansion candle, and candle number 3. This is the imbalance. Now, the fair value gap, again, is the wicks, the space between the wicks of the first and second candle. So if you see right here, this open space, that is our fair value gap. This is on a 1-hour chart right now. You can look at fair value gaps on any time frame, but the higher the time frame, the more significant they're going to be. Now, I also want to show you guys, while you're learning how to plot these fair value gaps on your chart, you can use the custom indicator from Edgeful, where if you see right here, it will automatically plot these on the chart for you, which is incredibly helpful. I still use this indicator sometimes because it's really easy to kind of get lost in certain fair value gaps and miss some things. So every now and then I do have this on my chart still to this day. But if you see here, I want to go over this because this whole thing on the price action for the last week or so has been perfect in showing how fair value gaps work. So I want you to see here where the Edgeful indicator has plotted out all of these 1-hour fair value gaps. They have been unmitigated, so that means they have not been tapped into yet. We have 1, 2, 3 1-hour fair value gaps. These are imbalances. What did we say earlier about imbalances? They act as magnets for price to draw towards, so they can be used as a directional bias. The market is going to be attracted to coming back down and filling these open spaces. Now, we make our all-time highs, we take out this high, and we start to displace down. Market sweeps the high, displaces down, we create this 1-hour fair value gap, also known as an imbalance. Now, the market is going to be attracted to filling these open spaces. So watch what happens. We start to consolidate, so we find some support around here in this zone. Market chops around, and we start heading back up towards the imbalance. And this is what they're used for. The market is going to be attracted to these open spaces. Now watch how we fill the space. So we have this down move, we come into the gap, it acts as resistance. I'm just gonna extend this out. I believe we have another tap back up into the gap to fill more space. So we've basically filled most of this gap, but we have not closed above it, meaning that this fair value gap, 1, served as a draw on liquidity for the market to trade up into to fill the open space, and number 2, it's now acting as resistance. So This right here is showing you how the fair value gaps work in both instances. This single fair value gap did both. It gave us a directional bias, and now it's acting as resistance. So we start rejecting down. So this gap acted as resistance. We're now moving down, and remember, we have all of these gaps down here that the market is going to be attracted to filling. So let me extend them out. So the market is just tapped into this one. We're going to put these as green for buy. These are bullish fair value gaps. The red are bearish fair value gaps. Now let's just extend these out. So let's see what the market does now. And we fill the open space. And this is what I'm talking about on why these are so powerful, because they give you a direction to trade in, which I always emphasize this. It's not just about finding the perfect entry. You need to have a target. You need to have a directional bias, and fair value gaps or imbalances give you that directional bias, which is something that so many newer traders are missing, and it's why they're struggling still. You can't just look for entry signals. You have to have an idea on where the market is heading first. It's so, so important. All right, so now to get a little more granular, I want to show specifically how you can use a fair value gap to spot a higher time frame to medium time frame reversal. So if we see here, we're back in the replay mode, and we're at a similar point in the chart. We had made our all-time highs right here on July 11th. We have now displaced down. We're on the 4-hour chart, and we are looking for an area to potentially get a bounce from, because this is a pretty large displacement move down. We are in a bull trend. We're still in a higher time frame daily and 4-hour uptrend with this pullback. That's the context we have at this time. So I'm looking for my higher time frame for value gaps to find potential areas of support. So right here we have this 4-hour gap. If you put the edge full indicator on, it shows it right here. We also have a gap right below, but we are going to focus on this gap right now because that's where price is at this moment. Now we have our higher time frame zone. So this is the area that I was looking for a potential bounce on. Now, before we get that bounce, we need to see a few things. We don't just want to buy right as soon as the market touches a fair value gap, especially as a day trader. You know, we're using tighter stop losses sometimes, or we're on the lower time frames, and this is a large gap. I think this gap is like 200 points. All right, it's about 100 points on the NASDAQ, though. That's a lot. That's pretty significant still. You can't just buy here and use a 100-point stop loss on the NASDAQ. You have to now jump into the lower time frames and try and find an entry. But this is our zone. Now, I'm also marking off these swing lows because I want to see the market sweep liquidity first before reversing. That's a key component to trading ICT. So we have this swing low and this swing low. We have swept this low. Now, we don't just want to buy because we swept a low. At this point, I want to start looking for some type of structure shift to signal that buyers are back in control, because we also have the fair value gap up here. So let me mark this one off. Now remember, we can use fair value gaps for support and resistance. We can also use them for directional bias. In this case, we're using both. We're using this 4-hour gap as our support floor, and we're using this gap as the area that we think price can draw towards. So if we go to a lower time frame now, basically what I want to see is some kind of market structure shift after a sweep of liquidity. So let's just play this out. We have swept this low, but I really, at this point, I remember thinking that we're probably going to come for this low as well, induce traders here, get them bullish, and just sweep the lows one more time. So let's just play out some price action. Ideally, I want to see this high get taken. That would signal a significant market structure shift for a lower to medium time frame to then potentially come into this gap. Let's see what time. This is London session right now. So we do come back down, kind of create relative equal lows right here. Okay, so now we have the start of New York session, 8:30 a.m. We sweep these lows one more time. We also sweep this structural low. We've dug a little deeper into the fair value gap. So we've filled most of this imbalance now, and we can look to hopefully trade price up towards this imbalance, because that's what the market's doing. It is hunting liquidity, it's rebalancing to inefficiencies, and it's rebalancing to equilibrium. Those are the three things the market is doing at all times. Right now, we have just hunted liquidity, we have swept it, and now we are rebalancing into an inefficiency. That's the idea for this trade thesis. But we still need to get some confirmation. We need a market structure shift. Okay, boom. So right there, we take out this high with displacement. Now, what do we have right here? We have a 15-minute fair value gap. Now what I would like to see is for price to trade into this gap, hold as support, to then trade towards our draw on liquidity, which is the imbalance, the 1 hour fair value gap up here. So we trade into the gap, immediately tap into it, and we continue to expand upwards into the imbalance. And that's a trade idea right there during New York session. And that's exactly how you can frame a higher time frame reversal with the lower time frames, using fair value gaps as a support floor in this case, and as a draw on liquidity in the same idea. All right, now you may have noticed that I've really only been using higher time frame fair value gaps when I was going over how you can use these, and that was intentional. Now, I really wanted to make sure this video was catered towards people that are brand new to this concept. And my opinion, if you're brand new to this concept, you should stick to using higher time frame gaps because they're just higher probability. And right now we're in the Edgeful dashboard and we are looking at the fair value gap report, and this is going to show us why. So if you see here, if I go to the customization tool, they have data for 5, 15, and 30-minute fair value gaps. Now, they're probably going to get higher time frames later, but for now, this still gives us some pretty interesting information. So if we go to the 30-minute time frame, which is the highest time frame they have right now, if you see here, 62% of 30-minute fair value gaps are unmitigated, which means they held price. They have not been invalidated in that same trading day. Now, these stats really change when you get into the lower time frames, such as the 5-minute. If you see here, only 35% of 5-minute fair value gaps have remained unmitigated by the end of that trading day. Now, this by no means that 5-minute gaps don't work. It's just that you need to have more information. You need to have been using these to be able to identify those higher probability, lower time frame gaps. And that comes with time and more information on this. Like I said, we're really only scratching the surface here. There's so much more I could talk about, but I really wanted to keep it simple for that trader that is newer to fair value gaps. Now, if you want me to make a video on that, I'd be more than happy to. I could also point you in the direction of some content where you can get really detailed into how fair value gaps work on all time frames. But that would be for another video. So if you liked this, shoot me a comment, send me a message. I'm always down to talk about it and explain more of what I'm talking about here. And that's going to be it for today, though, guys. Peace.